Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we'll talk with longtime friend of the show, Rick Rule of Rule Investment Media. And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
Rick, welcome back to the show. Always a pleasure. Thanks for coming back.
Pleasure to be back with you. I enjoy the process.
Yeah. So I had this really evil thought before we hit the record button. I thought, I think I'm going to ask Rick all the questions he hates the most. Stuff like, when's gold going to go to 10,000 and, the like. But maybe I'll just leave it at that one horrible question, and then we can dispense with that and move on. So, what do you tell people when they ask you when gold's going to go to whatever price they want, 5 or 10 grand or whatever?
I usually explain to them that I've looked into the track record of a lot of market forecasters in my life, and most of them have track records unblemished by success. And rather than disgrace myself in their company, I duck questions like that. I enjoy the question, when is gold going to move? And I tell people in response to that I began to add to my gold bullion holdings in 1998, a bit early. But in the period 2000 to 2024, the gold price moved from $253 or $256 an ounce to $2,000 an ounce, over an 8% compound gain. So when people ask me when gold's going to move, I say 2000. Many people have an expectation of a gold move that is the type of hyperbolic gold move that occurred in the 1970s. But since people ask me a factual question, I try to give them a factual answer.
That's a factual answer. Yes. It's funny. I did notice at one point in my career, all the numbers that are facts are all in the past. So, it's all guesswork. In the future.
How true, Dan?
Yeah. So, that was one of the problems that I was facing. The reason why I came upon that insight was I was like, I just can't seem to make heads or tail out of making a discounted cash flow method work without being burdened with having to predict things accurately. I thought, well, this is driving me nuts. We sort of worked it out, but
it's important for your listeners to understand that a model is just that. And probably in terms of a model, you need to have 2 or 3 variables which you disclose. And as an example, if somebody's doing a discounted cash flow on a gold mining company, I suspect that they should run a $1,500 model, a $2,000 model, and a $2,500 model, and understand the chances that they get it right are somewhere hovering around nil. The idea is to give you a range of outcomes that you have in mind. There's so many variables that go into a model. The idea that you can get 10 or 12 variables right over a 5-year period of time is nil. So you need to understand the value of models, I think, for what they're worth. I construct them constantly, and they have used me. I have used them to great effect, but I have never believed in their implicit accuracy. I've regarded them as guidelines. They're very useful in comparing apples to apples, different companies, using the same variables in a model that you, rather than the investment banks, construct.
Yeah, that last part is key. Who was it? I forget who it was that said all models are wrong, but some are useful. I can't recall.
Correct.
Yeah. And you model, actually, I'm glad we got onto this topic, because it's one thing to model, say a bond, a stream of cash flows that you know exactly what they're going to be. Quite another to model a business that generates cash flow, and then another beyond that to model, how does one say, companies that have no revenue and have a claim to some amount of gold or copper or something that they believe is in the ground.
It's interesting what you just said, Dan. I think that's a backward-looking statement. The idea that you model a bond cash flow that you're going to get. I'm looking increasingly in the high-yield market where there's revenue streams I'm not sure I'm going to get. They're easy to model.
That's right.
But when I look at the
Exactly.
credit quality, I'm wondering, how certain is this revenue stream?
Yeah.
So
Fair
I
enough.
understand your point. I'm curious on a going forward basis as to how secure some of those revenue streams are.
I am as well. But the other point though is how can you possibly model a exploration mining company that doesn't have any revenues?
Here's what I do. I start by saying I'm going to get it wrong. I'm just going to get it more right than somebody who didn't model it at all. And what I do, what I choose my price case is a variety of price cases. So, and the most accurate models turn out to be the ones with the most depressed commodity prices. As an example, and this is going to be pretty obscure, but you asked it, so you're going to get it.
All right.
2.5 years ago, you looked at the uranium price at $20 a pound, and you knew that the incentive price to restart mothballed production, not new production, but mothballed production, was around $60 a pound. So you knew within the 5-year time frame, uranium was going to go to $60, or that the lights were going to go out because the industry wasn't going to be making any more uranium.
Right.
What was most likely to occur? The
Yeah.
price going up or the lights going out? Now, in fact, I was wrong, of course, because the price didn't go from $60. It went to $100. But in terms of the fail-safe nature of the model, that turns out to be a relatively good technique. I
Gotcha.
believe that your starting point is the industry's total cost of production, including social rents, which is to say tax and royalty, and including their cost of capital. When many of my competitors, particularly the ones who have to generate fees from their models, construct pricing models, they look at something called all-in sustaining capital, which is just the mine site cost, absent allocable G&A, absent social rents and tax, and absent the cost of capital, which I don't think is a good number.
ASIC, so-called. Yeah. So in other words, you create Rick Rule ASIC and you add all those things in and model them in.
If I have to pay them, I have to model them, don't I? I mean, there's nothing in the world that drives me crazier than pre-tax NPV. I guess if I didn't have to pay the tax, I wouldn't bitch quite so much about the model, but that's not on offer.
No, it's not. However, it is fairly standard practice, isn't it, in finance to focus on pre-tax operating earnings? Isn't
it is, because it's standard in financial practice to try and generate a fee. And if you don't use a model that generates a positive return, you can't hoodwink the buyer into buying. And if you can't hoodwink the buyer into buying, you can't get a fee.
Now,
This is and the idea that people are doing these feasibility stage models without factoring in the cost of capital astonishes me, but they do, and people buy them. I guess the third bitch, since I'm allowed to bitch here,
yeah.
is people who are doing net present value calculations using a 5% discount rate when the issuer being modeled has a 13% cost of capital. Explain to me how that works. Well, I know how it works. It works in Chapter 11.
Yeah, it doesn't work. Well, it may work in some cases. It may work to get somebody to cough up some money at
Yep.
some rate or another.
Yep.
But
It does that.
down the road, it doesn't turn out well. Okay, so I want to back up to the uranium price because
Great.
you said something interesting. That incentivization price, $60 a pound.
Yep.
Now, I've thought about this a little bit and talked with some folks about it a little bit, and it seems like we all agree that at the incentivization price, capital does not come screaming into the sector.
Correct.
It's not like it hits 61 bucks an ounce and everybody says, oh, turn on the uranium spigot. In fact, it takes substantially more than that. So it would seem to me that you, once you hit that incentivization price, and now you're up at $100 where we are, um, you you have a different game to play, right? You're not playing that $20 a pound or whatever it was game. You're now saying, you're now, aren't you now looking for, when the capital begins to sort of flow into the sector, and when the supply begins to respond to the price?
Well, more importantly, this is a very lengthy topic, but we'll begin, and you can shut me off when you want to.
Might not want
the
to.
the incentive price in the near term doesn't impact production very much, because you have to permit the mine, which in the case of uranium is an interesting chore. You have to finance it, and then you have to build it. In the case of the uranium business, there is about 30 million pounds of production, which is in production hiatus, meaning that it could be turned on within a year and a half. This price of $100 a pound in the spot market is plenty enough to return that to production. However, in the case of the two largest producers, potential producers of this shut-in production, both have said that they won't restart the production hiatus until they have sold enough future volume into secured long-term markets that their shareholders are assured of a reasonable return on capital employed. It is interesting that the uranium market has a developed term market, unlike any other commodity on the planet. So it will be possible for Kazatomprom and Cameco to enter into 3-year contracts or 5-year contracts or 7-year contracts or 10-year contracts. And this makes the uranium industry unique among natural resource businesses that I'm aware of in the world. Most commodities around the world are sold at spot or are sold in the futures market, which means that a company's revenue line is determined second by second in public markets. Increasingly in the uranium market, the spot market is irrelevant. Transactions are being done in the term market. And that has profound implications, both for uranium investors and also for securities analysts like you and me. Having the ability to predict the revenue line with regards to sales as much as 10 years out for any amount of material that's been contracted means that we have price certainty and hence revenue certainty in uranium that we don't have in any other commodity on the planet. My suspicion is that in the 5 to 10 year time frame, this lowers the cost of capital on the debt side in particular. The people who are providing the senior secured construction finance with uranium, unlike any other substance on the planet, can look at the revenue line and understand that enough has been sold forward, assuming the attainment of nameplate capacity, to amortize the loan. A luxury that I have never had in commodities lending for the rest of my life. Secondly, securities analysts who want to analyze the equity have a better sense of the potential revenue line than they can with regards to any other commodity. So it's interesting that you got into this can of worms, because we're changing the structure of the uranium market as you and I speak. There are 68 reactors, as I understand it, under construction, and somewhere between 110 and 150 reactors in the planning and permitting phase. And as I say, there's an increasingly robust term market. The lenders around these new plants increasingly are requiring the plant promoter to secure access to enough uranium over a long enough period of time that it substantially amortizes the loan, which is really truly a wonderful state of affairs. It is highly likely that world consumption of uranium doubles over 15 years. And I think what you're going to see is the most of that demand, not some, but most of that demand, subject to term contract, which means that in the uranium business, you're going to have a much more structured market than you have in any other natural resource business, which I think inures to the benefit of everybody.
Right. And on both sides of this, right? Capital providers and then issuers, they both have
Correct.
there's a sort of discipline built in here that you don't find anywhere else.
Now, the thing that's going to be challenging for you and me for the next 2 or 3 years is that the industry's reporting around these contracts is opaque at best. And so I've had to do such crude things as look at Cameco's quarter, look for pounds sold, and then look for price per pound. Look for variations from spot and try and figure out what their term book is. I think what's going to happen is that in the quest for capital, the companies who are more candid and forthright with regards to their term contracts are going to enjoy a lower cost of capital. Certainly, I, as a lender, if somebody is coming to me to build a $500 million uranium mine, it's going to have a lower cost of capital if I understand what they sell that uranium for.
Right. So yeah, that's right. Whoever, and whoever gets out there first with it, they're going to have a much more advantage than second, third, fourth, or whoever, right? So, if I were whoever,
I'm not sure about that. I think that
no,
I think that everybody will follow the lead dog pretty quick.
okay,
Now,
all right,
remember that you really have to concern yourself right now with Cameco and Kazatomprom. They're the people that have the most near-term productive capacity. They are also the people who have the best development timelines. But when you look at some of the companies that have advanced projects that will be put into production in the next 10 years, I'm thinking in particular NextGen, the ability that they might have had as an independent to build a $5 or $6 billion mine in Western Saskatchewan as independence was nil. The ability of them to finance a $5 or $6 billion build with purchase contracts in hand from investment grade counterparties is much different, particularly if they can get a fixed price contract on the build, so that the banks look at the arbitrage between construction cost, revenue, and cost of goods sold. This really does change the nature of the game for the developers potentially.
okay. Now, do you know all these people? Are they thinking this way? Are they thinking, we should start telling the world all this information so that we can beat down the cost of capital?
The uranium business has operated according to the rules at hand as opposed to the rules that were going to be for a very long time. Even uranium investors look at the spot market as being the price determinant, but about 70% of the current volume is taking place in the term market, not the spot market. And the spot market itself has become much more liquid, not just because the trades are elsewhere, but because of the overhang, the inventory overhang that depressed the spot market is gone. My former employer, Sprott, not to be confused with Sprott, bought 45 million pounds. So that's supply that went to supply heaven. And then the supplies that the Japanese reactors had, which when they were shut down, were regarded as goods for sale, at least by the international community, are now inventory for the restarts. It is interesting to note that the share volume in the Sprott Physical Uranium Trust on a daily basis is very often higher than the daily volume in the spot market. So it could be it could be suggested that the Sprott market is the spot market, that in this circumstance, the tail wags the dog. And I think that's going to become increasingly apparent in the uranium business. And I think the realization of this among all actors is increasing.
What can you tell me about this differential between, if you go to the Cameco website, just for the listeners' benefit, they publish this chart that updates the uranium spot price at about $100 and the long-term uranium price, which I assume is this term price we're talking about, at $72 on the last tick here.
Yep. The price that matters is the 72.
Right. So 72 is not nearly as high above 60 as 100. So
remember that my 60 includes cost of capital. So my 60 is not an AISC number. 72 is a lot of money, and the $72 also refers to the floor price in the term contract. Most of these contracts have a minimum price, with escalators across a variety of features depending on the term of the contract. So a $72 term contract is paying you 72 today, and some number that's marginally higher than that next year. It is plenty adequate. It doesn't set speculators' hearts racing the same way 100 does, but the $100 number is really a floating abstraction.
Who pays it again?
There are lots of pounds currently transacted in the spot market.
Okay.
It's just becoming increasingly less important, and it's a quarter as important as it was 3 years ago. It is important in speculators' minds and in uninformed investors' minds because it was the pricing metric that mattered 3 or 4 years ago. Increasingly, it's a pricing matter that's really a reference point now.
I see. And it seems like the reference just kind of, tells you where you are versus where you were. I mean, it doesn't sound like it tells you.
I'm not even sure it does that. It's maybe a factoid, something that's important only because it's believed to be important.
I see. So it's there,
or maybe
and
it
we have to pay
represents
attention.
liquidity.
Oh,
It might represent liquidity.
Mm-hmm. Oh, wait a minute now. Liquidity how?
In the sense that somebody who has access to 100,000 pounds in the term market and needs another 15,000 pounds to fill out their refueling obligation looks to the spot market
I see.
merely for liquidity, for overage and underage with regards to inventory.
Gotcha. All right.
Certainly, it will be used by the traders to arbitrage. If Itochu, as an example, contracts for 100,000 pounds a year for 10 years, and they find themselves in need of 120, maybe they find it 20 in the spot market. If they have 10,000 too much, maybe they lose it in the spot market. That makes perfect sense.
I see. So, is it fair to say that if we are in a sort of long-term uranium bull market here, we're fairly early on still?
Dan, I think the easy money has been made.
Okay.
The easy money is in the transition from the commodity being hated and in liquidation to the commodity being tolerated and now liked. I wouldn't say the commodity is loved. So the easy money has been made. A basket of juniors back at the time when you and I were talking about uranium in 2022, this basket is up 300%. The prudent speculator sells a third of his position and has the other 2/3 for free. I call that the point of no concern as opposed to the point of no return. And I have done that, and I'm happy with that position. Unusually, and unlike any other commodity I know, I think the sure money is ahead of us. In the sense that I've never seen a commodity before where there's revenue certainty out as much as 15 years. And looking at the enterprise value of a company relative to the net present value of cash flows at prices that have been entered into with investment grade counterparties, there's a level of certainty, a level of sureness in that I've never seen before.
And Rick, this is Corey. Where do you see? You mentioned going back a little bit. You mentioned demand. You think doubling in the next 15 years for uranium. What parts of the world are you seeing that happen from, in your view?
Really, you're seeing two things. You're seeing a deferral of shutdowns in the West. Reactors that were supposed to go to reactor heaven that miraculously have been resurrected by the legislatures in various countries around the world. But most importantly, what you're seeing is an incredible pace of new build construction. Mostly China, but also the UAE, also India. As I say, 68 or 69 plants under construction. It's also important, Corey, as a sidebar, to know that when you look at the plants that are being built today, they are very large plants. If you look at the plants that were built in the 1970s, you're talking about a plant that has a quarter of the output and a quarter the uranium consumption of the kind of plants that are being built today. The number that I quoted to you is a World Nuclear Association number that just extrapolates from the deferral of closure and the construction of new plants that have been funded.
I can remember us talking on this show not terribly long ago, and I said, Rick, is there one commodity out there that's really just beat down and compelling? And it was uranium.
Yep.
I'm gonna guess that's not how you would answer that question today. So how would you?
Two commodities: North American natural gas, stupidly cheap,
Yep.
stupidly cheap, and we can talk about that. And one that's getting cheaper that isn't cheap enough yet. Well, two: nickel. The market's in total disarray. The mining companies are shutting down sulfide nickel operations around the world. Investors who loved nickel 3 years ago as a battery theme are starting to hate it. There's no hate as sincere as the hate of a jilted lover. And you're seeing that around the battery metal speculators. And I would also say platinum and palladium, their sell-off has been important. The narrative is from the big thinkers that the internal combustion engine is going the way of the dodo. And if that happens, the need for catalytic converters is going away. The big thinkers are, as always, very, very, very wrong. The internal combustion engine isn't going away anytime soon. And the demand for catalytic converters, saying that the demand for catalytic converters is going away is like saying that the demand for smog is going up. It's a highly unlikely statement. So I suspect that the market for both nickel and platinum and palladium continues to deteriorate. Among other things, no mystery to your viewers, the Russians, for various reasons, need money. And when they need money, they sell what's on the shelf. And part of what they have on the shelf that's at least fungible is nickel, platinum, and palladium. We saw this in 90 and 91. When does the selling end? When the Russians run out. That's fairly simple. With nickel, the other problem has been the incredible increase in nickel production in laterites from Indonesia. I recently flew over those nickel operations in southern Sulawesi. And while I'm not best described as a bleeding heart, the environmental degradation that's occurring in southern Sulawesi is breathtaking and is not sustainable. So my suspicion is that the rate of increase in production in the Philippines declines, perhaps absolute production declines, but much more importantly, the shutdown of sulfide nickel operations around the world, which has been announced, will begin to bite, just like the shutdown in uranium production in 2022. Bit. Meanwhile, the process of Russian dishoarding will end when the Russians have nothing left to hoard, which I suspect happens in 12 months. If you ask me 18 months from now what the commodities are that are roundly hated and that are priced well below the cost of production, the answer is going to be nickel, platinum, and palladium. So I'm building a shopping list now in anticipation of activating it when the hate is more extreme. Right now, North American natural gas, I think, is uniquely cheap. It's in substantial oversupply as a consequence, really, of political opposition in both the United States and Canada to new energy infrastructure. And it's in oversupply also because it's produced as a byproduct of shale drilling for oil, particularly in the United States and the Permian. In the United States, we produce more natural gas as a byproduct right now, even than we can store. Never mind gather, process, and transport. Natural gas is, as we speak, priced at about $2.50 million BTU in West Texas. That same gas in Rotterdam or Shanghai is priced at $8 or $9 a million BTU. It costs between $1 and $1.50 to get it from Midland to Rotterdam. So you have a $4 cost against the $8.50 market. That arbitrage is too big to exist. And the BTU differential between oil and natural gas is also too big to exist. given that I personally don't experience a decline at all, particularly not a precipitous decline in the oil price, I think that arbitrage gets resolved higher. And until 2 weeks ago, Mr. Biden's announcement that he is snatching defeat from the jaws of victory by considering a hiatus in U.S. Liquefied natural gas construction, the industry was spending literally billions of dollars constructing gathering systems, transportation systems, processing systems, and liquefaction systems to address specifically that circumstance. Meanwhile, energy users, particularly in Europe, particularly in Germany, are shutting down in mass and relocating in the United States, where they have access to that gas. And incredibly, despite the fact that natural gas prices are pathetically cheap, some natural gas producers, both in the United States and Canada, are still generating good free cash flows, making good returns to shareholders, while reinvesting enough of their cash flows to maintain production. The idea that you can play a theme which will resolve itself in 4 years with no discount for net present value because the dividends are so high is nothing that I have ever seen before in my career.
Wow. You got a name for us?
Several. I don't think you need to get too tricky with this. You don't need to go too far down the quality trail.
Yeah.
I think you can buy Devon if you care about the Mid-Continent and the Anadarko Basin, and for that matter, the Permian Basin, and Equitable if you care about the Marcellus, both of which I care about. If you're willing to take a tiny bit more risk, I think you go north of the border. I say a tiny bit more risk because the guy who runs that country doesn't like the fact that they're able to produce oil and gas and generate a surplus for him to waste. Names up there would include ARC Energy, ARC, Freehold Royalty. Those are the two more conservative names. Peyto Resources, Birchcliff Resources, both pure plays on gas, and Tourmaline, a light oil producer that's an important gas and condensate producer too. It's important to note that that whole basket could be bought in a yield portfolio. It wouldn't need to be bought in a commodities portfolio.
I have to speak up here, Rick. I love this. The reason I love this is because you can basically buy cash gushers, well-managed, fantastic assets, good balance sheets, generally speaking, right? And still, through the cycle, make 5 or even 10 times your money. That really turns me on. I mean,
I'm not sure in these names you're going to make 10 times your money.
Okay. I mean,
but
3 or 4.
Yeah, 5.
Okay,
here's what you got to look for, Dan. Your listeners are going to get so tempted by this theme that they're going to come down the quality trail looking for dividends. It's important that your listeners pay attention to companies that are maintaining enough sustaining capital investments that they will be able to produce in the same volumes 3 or 4 years from now that they are today. If you take the oil and gas industry as a whole, they're not doing this. They're decapitalizing. The oil and gas industry as a whole, if you add back state-owned firms, is underinvesting in sustaining capital to the extent of about $1 billion a day, which means while they may be generating cash, they're cannibalizing themselves. So you need to buy companies that A, reward the shareholders, but B, are making enough sustaining capital investments that they will continue to produce in the out years. That's an important consideration.
It is. And when you go farther down, you find people who enthusiastically just kind of constitutionally just love to pour money into the ground no matter what. There's this whole class of people in the natural resources world. But there is this tier that understands it's a business, which just saying that shouldn't be remarkable, but it is. And I get very excited about those because I know you can make multiples of your capital over time in the cycle. And to me, that is really, really exciting. That, to me, that's what value investing is all about.
One of the things I've done wrong in my career, one of many, has been because I'm always early. I always have a cost of capital or a discounted net present value consideration. The first time I was in the uranium space, I was 6 years early. And if you're 6 years early to 8% discount, it's arguable you're not early, you're wrong. Now, the truth is that the basket of juniors that I invested is the wrong phrase, speculated in at that period of time, the worst of the 5 juniors in that period went up 22 to 1. And so you overcame the time value of money problem. But in other commodities, I haven't been so lucky. The fact that you can play the North American natural gas game with a sort of a 5 or 6% median yield means that you don't have a time value of money consideration if you're right about the theme, provided that the companies that are paying that 5 or 6% yield are reinvesting enough proceeds that they can maintain production.
All right. That's a critical point, folks. Listen to what Rick said. Write it down. Enough capital to maintain production. We've actually come to a time for our final question. You've answered it before. I hope you don't remember it because it's better. It works out better that way. But it's the same question for every guest. And no matter what the topic, even if it's a non-financial topic, same question, same final question. And that is, if you could leave our listeners with a single thought today, what would it be? And if you've already said it, feel free to repeat it.
In terms of natural resource investing, you are either going to be a contrarian or you are going to be a victim. There isn't very much by way of middle ground. Everybody wants to invest in commodities where the price action has already justified the narrative, but the price action takes the value out of the narrative. You have to look for commodities that are in liquidation, where the price is so low that the industry is liquidating, and where if the price of the commodity doesn't increase, the commodity will become unavailable to humankind. And finally, humankind needs to need that commodity. Another way to put that phrase in terms of the time value of money is that you need to invest in things that are inevitable, even if they aren't imminent. And you need to know the difference between those two words.
You sure do. Thank you. Great answer. A classic answer. That's a classic Rick Rule answer. I'm glad you said all that. I can't even remember the first time I heard you say the victim or contrarian thing. We were probably both a lot younger and had more hair. But listen, Rick, thanks for coming back and talking with us. And I hope it's not long again before we do it again.
Always a pleasure, Dan. If I might, I'd like to make my traditional offer to your listeners.
Please do. Yes.
Which is to say, if you like the way I think and talk about natural resources, but you want to personalize it, go to my website, ruleinvestmentmedia.com. List your natural resource stocks. Please no crypto. Please no pot stocks. Please no tech stocks. I'll rank them. No obligation, no cost. 1 to 10, 1 being best, 10 being worst. If I think my opinions have value on any specific company, I'll give them. I'll comment on issuers where I think my comments might have value. Once again, ruleinvestmentmedia.com. List your natural resource stocks only, please.
All right. I hope you'll all take Rick up on that. Well, maybe not all right at the same time.
It's all right. It's all right.
Yeah. All right. Good. All right, Rick. Thanks again, man.
Always a pleasure. Thank you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.